professional traders are going to try to, get what they can out of it. But I think for the vast majority of people, I would just point to that it's by most metrics a kind of a deep value zone based on a lot of different metrics. I think it's attractive with a 3 to 5 year perspective. If you monitor the fundamentals of the network, if you think the network's healthy, if you think all the aspects are still working as intended, if you don't see that there's any sort of competitors that are anywhere near close to what Bitcoin offers, then I think it's a strong buy. And I would just caution that, I do think that there is potentially a period of turbulence, in the second half of this year, once some of this debt ceiling stuff's resolved. I think we still are not out of the woods yet there.
Macroeconomic trends and their effects on different asset classes are the main areas of study for investment strategist and economist Lyn Alden. She is renowned for her in-depth examination of economic data and her knowledge in the subject. In a recent interview, Lyn Alden talked about the connection between Bitcoin and the present economic situation, money supply expansion, and inflation. She discussed the way she monitors the expansion of the money supply in various nations as well as the historical relationship between Bitcoin and the expansion of the money supply, particularly when expressed in dollars. According to Alden, Bitcoin has historically shown to be a reliable bet on USD liquidity, with prices typically rising in tandem with an increase in the amount of money in circulation. She claims that recently there has been a modest easing of liquidity, which has helped pave the way for the current surges in Bitcoin prices. Let's now jump into the video. Additionally, as you watch, be sure to click the like button, subscribe, and a comments buttons, and take a moment to provide any feedback.
Part of my work is I track money supply growth quite a bit in different countries. And one thing you generally see is that Bitcoin has been historically very correlated with money supply growth, especially when you take global M2, so global broad money supply, and you translate it all back into dollars. And so the two big components there are, one, are a lot of countries printing money, and two, how is the dollar performing relative to those other big currencies, right? The euro, the yuan, yen, all these kind of major currencies. And generally, when that's rising very quickly, especially in rate of change terms, that's usually historically coinciding with the last 3 Bitcoin bull runs. And when that starts kind of rolling over and consolidating, that's when Bitcoin has also historically kind of consolidated. And inflation historically comes somewhat after money supply growth. It's basically a side effect that happens on a lag. And so when people, the inflation that people saw taking shape in 2022 is in large part a result of actions that happened over 2020 and 2021. And so, for example, someone did buy Bitcoin well ahead of that. If they were anticipating inflation, if they, saw that, this kind of fiscal stimulus and money supply growth was happening, if they purchased Bitcoin, it did, protect them against the ravages of those inflation, just not perfectly timed with CPI that they see. So that's one thing I'll kind of point out, because now we're in the 2022 is the phase of the Fed fighting back on some of the things that happened in 2020, 2021. And then going back to the idea of liquidity, basically domestic liquidity indicators, there's been a popular ratio that I've seen floated around and I've incorporated into my own analysis. I used to do similar ways of adding it together, and I like this one a lot, so I incorporate it, which is basically you take the Fed balance sheet and then you also take the Treasury general account, because they have basically a cash account at the Fed, and any money in there is essentially dead money, right? So when that's growing, it's actually sucking money out of the system, and when that's shrinking, they're putting money back into the system. And so when you kind of take those together and you add things like reverse repos, you can get a liquidity measure that is actually rather correlated with risk assets in the United States. And when you look at a global liquidity indicator, in recent years, the dollar index is probably about as good as you're going to get, or dollar denominated global money supply. And that's because so many countries in the world have dollar-denominated debts, right? The dollar is for the most part, the unit of account for the world. That's changing somewhat over time, but most commodities are priced globally in dollars. Most international trade is denominated in dollars. And there's $13 trillion in dollar-denominated debt outstanding in the world. A lot of developing countries, when they borrow from international sources, it's done with dollars. And it's not even lent by Americans usually. It's usually Europeans, Japanese, Chinese. These, even though they're denominated in dollars, the lenders are all around the world because it's the global reserve currency. And so when you have the dollar strengthening relative to a basket of other currencies, essentially their liabilities are hardening compared to their cash flows. and vice versa. When the dollar is weakening, essentially their debts are getting devalued relative to their other currency cash flows. And so when that, especially when that changes in a very kind of short period of time, like when it strengthens or weakens very rapidly, that can cause a liquidity squeeze or a liquidity loosening. So those are kind of some of the things I look at either domestically or internationally when talking about liquidity, which is already kind of a jargony topic to begin with. Earlier part of the discussion, we talked about liquidity, right? So liquidity conditions all throughout 2022 were worsening based on various ways of measuring it that I talked about before, until we got to around quarter four. At that point, the Treasury General Account was drawing down, which was actually pushing liquidity back into the market and offsetting some of the Fed quantitative tightening. Basically, more of that monetary base was kind of out into the world rather than locked away. And so it's kind of this like temporary offset. And now with the debt ceiling, they're unable to issue new debt. And so what historically happens is some of the measures they take to avoid defaulting until that's sorted out is that they empty out their cash account. It's kind of like if you lost your income, but you had some savings and you still pay your bills for a few more months. That's kind of what the Treasury's doing right now, and that's actually ironically good for market liquidity in the moment that it's happening. And so starting in Q4, you had like a stabilization and then an improvement in liquidity conditions, at least temporarily. And I think you started to see like gold and other assets kind of start rallying in quarter four. And I think you probably would have seen Bitcoin do something similarly, if not for the industry-specific blow-up that happened, FTX, Alameda. So I think some of what we saw in January is kind of like a delayed, function to kind of play catch-up a little bit. Now that we're seeing a little bit more just, boringness in the industry, it's able to catch some of that liquidity and start recovering. I do have some concerns around the second half of the year because once they resolve the debt ceiling, you're going to see the Treasury almost certainly try to suck back liquidity out of the market to fill back up its Treasury account. And if the Fed is still withdrawing liquidity at that time, you could have a rapid decrease in liquidity. So you could get negative retests, you could get consolidations, corrections. But it's unclear how that's going to play out. And it's possible that the Fed will not even be able to still be quantitative tightening at that time. It's possible that the Treasury will try to draw up very slowly. We don't know exactly when or how the debt ceiling is going to be resolved. So a lot of this is guessing game, and it's hard to say if Bitcoin, rallies and then corrects from whatever level it rallied to. It might not correct back down to where it is now, or it could, right? So I think basically traders, the professional traders are going to try to, get what they can out of it. But I think for the vast majority of people, I would just point to that it's by most metrics a kind of a deep value zone based on a lot of different metrics. I think it's attractive with a 3 to 5 year perspective. If you monitor the fundamentals of the network, if you think the network's healthy, if you think all the aspects are still working as intended, if you don't see that there's any sort of competitors that are anywhere near close to what Bitcoin offers, then I think it's a strong buy. And I would just caution that I do think that there is potentially a period of turbulence, in the second half of this year. Once some of this debt ceiling stuff's resolved, I think we still are not out of the woods yet there.
Lyn Alden concludes by saying that, notwithstanding the recent industry-specific bloop in the cryptocurrency market, Bitcoin is still a desirable investment option when looking out 3 to 5 years. She does, however, issue a warning that the second half of the year may experience some turbulence as a result of the debt ceiling agreement and probable liquidity issues. She recommends investors to exercise caution when making investments and to keep an eye on the network's fundamentals. Overall, according to Lyn Alden, this is a good time to acquire Bitcoin if the network is stable and there aren't any direct rivals, which is highly improbable given the current state of the market. Do you think the most recent market rally is a bull trap? In the comments box below, please share your thoughts and worries. Thanks for watching. Please remember to give us a like, subscribe, and enable notifications for new videos.